Okay, so in this video for Intermediate Accounting Chapter 2, we are going to look at Step 3. Make sure that you watch the videos prior to this so that you know what steps are leading up to this. But we're going to talk about the accounting cycle and when we actually start recording journal entries. Recording the journal entries is really important because that's when it officially is recorded on the books so that we have record of what has happened within the company. All right, so this is a super overwhelming slide. Y'all know I don't like to have overwhelming slides. But what this is a list of all the transactions that we are going to go through and record journal entries for. So I'm giving you this if you want to do a screenshot or you want to print it or take a picture with your phone so that you can follow along. Or perhaps you want to take these entries or these different transactions that have happened and pause the video and try to make the entries on your own. That way you can then compare them when we walk through it together. That's totally up to you, but I wanted to provide you with all of the entries that we are about to go through together before I started going through each one. So that's up to you if you want to pause it and take some time on your own. I find personally, when I see somebody do something like this, I'm like, oh, I could totally do that by myself. But then when I actually try it, I realize where I'm lacking. So that would be my recommendation, is to try to go through this and do the journal entries yourself, especially at this stage in intermediate accounting where you're trying to remember everything from financial accounting. These entries are not going to be super in-depth or super hard. They're going to get much harder as time goes along, but these are very basic entries. So we're going to start with these. All right, so the first one is an initial investment by owner, and some of these are going to look really similar to the ones we saw in the prior videos, but there's going to be some additional ones, and the ones that we do have may be quite different. So just prepare yourself. These are different journal entries from the prior videos. Okay, so we're looking at Young Counseling Services, and they received cash of $60,000 from two investors of $30,000 each. Each investor was issued 5,000 shares of common stock. Well, that's a lot of information. So let's talk about what we need here. If this all happened at one time, which we saw, I have the dates there. It did all happen on August 1st. So if this all happened at one time, you could break it out into different entries, two different ones for 30,000, but what we're going to do is just record one journal entry showing that we're getting cash of 60,000 and we are increasing common stock by 60,000. Now, it is important to know how many shares were issued because right now that means we have 10,000 shares issued, but we do not include that in the actual journal entry. Now, in the real world, you would always put a note to every journal entry that you make. So you would likely put the names of the investors and the fact that they're getting 5,000 shares each. But in the actual financial aspect of this, we're not going to show the 5,000 because we're showing this as monetary units. So we're increasing cash with a debit, increasing common stock, which will be our equity, with a credit. All right, the next one, we're borrowing money from the bank. So we borrowed $30,000 from a local bank, signing a 2-year note that bears 10% interest. So that means they're going to be paying this $30,000 back. It looks like at the end of the 2 years. And the 10% interest, anytime you see interest, it is annual. So they'll be paying 10% in the first year and 10% in the second year. And in this case, it's happening at the beginning of August, so it's going to be kind of split up between 3 years in reality. So when we make this initial entry, we are not going to take the interest into account. We are just going to show the cash coming in for 30,000 and the note payable. Remember, note payable is whenever it's really official, it's bearing interest, there's signatures. Accounts payable is whenever it's going to be unofficial, it's usually just an invoice. And the interest would come into play later on as time passes. But on August 3rd, when they first took out this loan, no interest has actually been incurred yet. So we don't record anything for that yet. Again, maybe in the note for the journal entry, we might put this is a loan, a 2-year loan for 10% interest, but we don't put it where it's actually going to show up on the general ledger yet. Okay, so now we have paid for rent in advance. So they paid $12,000 in advance for 1 year's rent on the space that they're going to be counseling their clients. So $12,000 for 1 year's rent. So they've got cash going out for $12,000. So we know it's going to be a credit to cash. But we don't show all of this as rent expense all at this time because there has been no time that they have actually incurred the expense yet. So right now that 12,000 actually represents a prepaid rent asset. So prepaid rent is an asset, which is a normal debit balance. So we debit that asset and we credit cash, which is also an asset. So we have two things happening on the asset side, two things happening on the left-hand side of the accounting equation here. Remember, with accrual accounting, we are going to show the rent expense over time, and we'll see that later on, but not in step 3, not in this video. All right, so now I did not label the top of that correctly, borrowed money from the bank. No, we're not borrowing money from the bank. They're purchasing office supplies from Blunder Paper Company for $2,000 on account. So since it's on account, we know they have not paid cash for it yet. So they're bringing in an asset. So we debit supplies and we credit accounts payable because it told us it was on account. So they're going to be paying the cash for that later. So we always credit a liability to increase it. All right, how are you doing so far? Hopefully better than I did with the borrowed money from the bank at the top. Next, we are going to purchase furniture. So they purchased $10,000 of extra comfy chairs for clients to open up on. So they're going to lay down and tell them, the counselor, what they're going through. They purchased it on account from Cherish Inc. So we purchased $10,000 of furniture. I put it as office equipment. You know, in reality, you could put it as furniture, or you could put it as office equipment. You know, you get to choose on some of those things. It has to be very clear to the reader of the financial statements, and it's going to be up to what your homework assignment is asking for as well. So if there's a drop down box when you get to choose which account, then you may want to look for office equipment. You might have to look for furniture. So in this case, I went with office equipment, and we debited that as an asset for $10,000, and we credit accounts payable because it says it was purchased on account. Those are some expensive, comfy chairs. All right. Now we have actually rendered some counseling services. So they counseled a troubled client earning $3,000 in cash. So we have cash come in and we show service revenue. Remember, debits and credits aren't necessarily good or bad things. When we debit cash, it increases it. But since revenue falls under equity and it increases equity, we always credit revenue. I think that is the number one mistake I see, especially in the beginning when it comes to accounting, is people want to debit revenue, but we always credit revenue. We always debit expenses. All right, now they're ordering some inventory. What kind of inventory do we order for a counseling company? So we purchased 500 copies of Misty Young's book, Mind Over Chatter, to sell to clients. The cost was $2,000. Okay, so they purchased $2,000 worth of books. This is going to be inventory. They're going to try to sell it for more. So they are paying $4 a book. If we took 2,000 divided by 500, we would have $4 a book. So we're debiting inventory, crediting cash. All right, so inventory is an asset. You might have to put in merchandise inventory. Just want to note something about inventory before we move on to the next entries. Perpetual inventory is where we keep up with the inventory account and the cost of goods sold account on a consistent basis. We are always, anytime we make a purchase, we are putting it in inventory. Anytime that we sell inventory, we show it in cost of goods sold right away. And if there's any merchandise returns or anything like that, then we're going to go ahead and show that right away. Perpetual inventory, they're always keeping up with it. And most companies are using barcodes for that kind of thing. Periodic inventory is where they are not keeping up with it on a constant basis. They are really going to do a count at the end of the accounting period, and they're actually going to use the purchases account for that. We're not going to get into that too much yet, but I just want you to remember there are different different ways that you can account for inventory. You're going to see most companies that are bigger companies and have lots of merchandise. We're going to see the perpetual inventory system. It's much easier to keep up with, but that means every time that you make a sell, you are also going to show an entry for cost of goods sold. And that's what we're going to see next. So they sold 15 copies of Misty's book at a vendor market for $10 each. The cost was $4 each, as we could have calculated on our own, and we did. So for our first part of this entry, we are going to show cash coming in because it didn't say on account. So they have 15 copies. They sold them for $10 each. So they have cash coming in of $150, sales revenue of $150. But remember, with perpetual inventory, we are going to go ahead and do a separate entry for the cost. The cost was $4 each. We need to take $4 times 15 copies, and we say the cost of these books were $60. So we debit cost of goods sold, which is treated just like an expense account, and we credit inventory. We're decreasing how many we have in inventory. All right, so it's always important to remember that as long as you're doing perpetual inventory, which typically you're going to be unless it says otherwise, you need to make both of those entries. All right, so now they paid Cherish the $3,000, $3,000 of the amount they owed them. Remember, they owed them $10,000. They paid them $3,000 here. So we are going to show accounts payable with a debit. We're decreasing the liability, and we credit cash for the amount that we have paid them. We're decreasing our asset as well. So now we just owe them just $7,000 more for those chairs. Now they're going to pay some employees. So they paid salaries for the first half of the month of $2,000. So we always debit expenses. So we're going to debit salaries expense. The reason we're using salaries expense, it used the word salaries here. Salaries is where a set amount for the whole year will be paid to those employees. Wages are when we're referring to paying them hourly. So you may have wages expense for hourly employees and salaries expense for the employees that are getting paid a set amount for the whole year. So you just want to pay attention to that. And then we're paying them cash, even if it's direct deposit or a check, we're still showing cash leaving. Then they receive a payment in advance. They receive $1,500 from a client struggling with procrastination in advance of their September appointment. Looks like they're doing a better job with their procrastination already. So we got money, but we haven't done anything for it yet. This is August. We're not actually going to do anything for it until September. Do you remember what account you put this in if you haven't actually given them anything yet? We're going to show the cash coming in. We have to record it because we got cash. But since we haven't earned it yet, we're going to put this in a liability account, deferred revenue or unearned revenue. Same thing. It just depends on what the book is asking for, what the homework problems are asking for. Deferred, like pushed off till later, or unearned. We have not earned this yet. Either way, it's a liability. It's the same account, just different names. We're going to show that as a credit because we're increasing the liability. Now, in September, when we actually do provide the services for this client, we will debit the liability, deferred revenue, and we'll credit revenue, service revenue. So then we counseled a client struggling with social anxiety when around her controlling mother, earning $2,000 on account. So this time we have done the work, they just haven't paid us yet. So in that case, if we've done the work, we show accounts receivable as a debit, and then we go ahead and show the revenue at that time. All right, so step 4, I'm going to go ahead and jump into because we're just going to be a continuation here of what we did with the journal entries. We want to post all of those entries to the general ledger accounts. So the general ledger is where all of the balances, so we did a lot of stuff to cash. We did several things to accounts payable. We want to then go to the general ledger and see how was all of the balances affected for these accounts. It just keeps up with the running total. So here is the balance sheet, the general ledger account for balance sheet. So we've got our cash, all of those are the transactions, all the debits and the credits. So see, they're basically like T accounts. And then it has the running total. So at the end of August, we had $75,650 in a debit, which is a good thing. We want to have a debit in cash. If we had a credit, that means we have a negative balance. That's not good. Prepaid rent we set as an asset, so that's good. It has a debit balance. We've got our accounts receivable and our inventory. We've got our supplies balance, our office equipment. All of those are our assets. Then we have our accounts payable, notes payable, deferred revenue. All of those are liabilities that we kept up with. Then under equity, we have our common stock, where those two people invested $30,000 each. And we don't have anything in retained earnings yet because this is their first year of business. So we have all of that, and if you want to take a screenshot or a picture of that, that'd be a good idea because we'll refer back to this. And then we're going to jump into the income statement and what this looks like on shareholders' equity, because this falls under retained earnings. So we have our services, our service revenue, and our sales revenue from selling some books. You know, we have service revenue for services we performed. Sales, we usually think of it being actual merchandise. And you can have several different revenue accounts if you have different aspects of your business, for sure. Cost of goods sold, treated like an expense, so it has a debit balance just like salaries expense. Cost of goods sold, typically we see in the income statement where it's going to be the multiple step income statement, and it'll have revenue, cost of goods sold, and that will give us our gross profit. Then all the rest of the expenses are listed out, but we'll review on that soon. So then we take all of those in the general ledger account, and we're going to go to step number 5 before we end this video. So we take all of those amounts and we prepare an unadjusted trial balance. We want to make sure it's balancing. So we're going to check for completeness. We just take all of those accounts. Cash, like we looked at, had a $75,650 debit balance. We list that in the debits. Accounts receivable had a debit balance. We do that for every single account on the debits. Then we look at every account that ended with a credit, and we add them up on each column and compare it, and it should balance. This is our unadjusted trial balance. So next, in the next video, we'll start looking at the adjusting entries so that we can reach our adjusted trial balance.